Stock markets are crashing. Why is this happening? And where to from here? I'm Biko Konstantinos, and that's what we're going to discuss today. If you enjoy this video, please give it a like. And if you're interested in quality, independent financial analysis, I'd love to have you as a subscriber. Let's have a look at some charts to see what's happening. Volatility has risen sharply, as represented by the VIX, which is the volatility index. We peaked just after the COVID crash. Since then, volatility in the stock market has reduced considerably, but as you can see by the chart, every now and then you have some small spikes of volatility occurring. The latest spike in volatility has taken us close to 28, which we've seen has been hit a couple of times recently. The question I ask when I look at this chart is, will volatility actually increase from here as we see more volatility broadly across the entire market, or will it continue in this range? The Dow Jones hit a high of 36,500 back in November 2021, and since then has dropped 2,000 points to around 34,500. We also had a gap here at the start of the 26th of November 21, which signifies fear in the market as it opened quite a lot lower than the previous close. Although this represents a drop of only about 5.5%, we need to have a think about why this is happening now and where to from here for the markets. The Omicron COVID variant has certainly created some fear in the markets. According to this ABC News article, the concern around Omicron is the higher number of mutations in its spike protein. It appears that Omicron has double the amount of new mutations that Delta has. As Omicron seems to have the largest number of mutations than any COVID variant, it is being taken very seriously by health organizations. Fears in the stock market were exacerbated when the Moderna CEO said that the current vaccines are likely less effective against the Omicron variant. Is Omicron the only reason for this latest dip in the markets, or are there other possible factors contributing? Chairman of the Federal Reserve, Powell, indicated that they would continue tapering and removing liquidity from financial markets. He's also changed his stance on calling inflation in the US transitory. Now, this is a big change in narrative from the Federal Reserve, and what that means is there's an increased likelihood that interest rates are going to raise sooner than originally expected. Now, you might be saying, isn't this Omicron variant just another step in the COVID landscape, which has happened multiple times before and the market has always recovered from it? We've had a number of variants now, and we've had a number of lockdowns that went longer than originally expected. Won't the market just shrug this off as another blip and return to full steam ahead? To analyze this question, we probably just need to consider the lay of the land and what's been happening to give us a bit of a sense of where to from here for the stock market and also real estate market. One factor that has contributed to a very healthy stock market has been the unprecedented COVID stimulus packages that have been released globally. This graphic shows the value of stimulus packages as a share of GDP for the following countries. Now, for the United States, this wouldn't include the latest $1 trillion package that was just recently approved. So considering all this global stimulus that has been released across multiple countries, you get the feeling that maybe the stock markets have been artificially inflated by the amount of money that's gone out. I've heard some commentators suggest that world governments have inadvertently created a massive bubble in all stock markets across the globe. So how can we tell if we are in a bubble? It's impossible to know for sure whether we're in a bubble because you'll only really see that later if there is a massive crash. However, there are some great indicators we can look at to see if overall the stock market is expensive compared to the average mean. One of the most widely used indicators or graphs to indicate expensive market is the S&P 500 Shiller Cape ratio. This looks at the price to earnings ratio over the entire S&P. so it gives us a good indication of overall valuations. This spike here was the 1929 crash. The highest spike ever in the Shiller ratio occurred here during the dot-com boom. Right now, up until the 30th of September 2021, the Shiller Cape ratio is trading at its second highest level ever in its history. This current level of 38 is over double the average of 17. This is a very strong indicator that the broad markets are very expensive compared to our long-term average on the stock market, which could infer that we could be in a bubble type territory. Another great indication is what's been nicknamed as the Buffett indicator, and that measures US total market capitalization of the stock market as a percentage of gross domestic product. This indicator has basically surged since 2010 and is now way above the average of 82%. According to Buffett, anything above 100% is in expensive territory. So now that we're above 200%, where does that put us? Super expensive territory? Finally, the average dividend yield of the S&P 500 is also a great indicator, as when prices rise dramatically, the average dividend yield drops. Right now, with the surge in the S&P, the average dividend yield has dropped to about 1.28%, which is significantly lower than the average of 1.86%. So how will we know if there's going to be a possible crash in the stock market? Going back to our Dow Jones chart, we can see there's been a massive uptrend since the crash after COVID. The price surged up dramatically, but since June, the uptrend line has been broken and the price has drifted sideways. More recently, this 34,000 mark has been hit a number of times, so the first sign for me that danger is ahead would be a clear breakdown below this 34,000 level. Now, what can happen after a sharp downturn like we've had recently? Quite often, the price can hit this support level, bargain hunters come in, and then they'll make the price rise from there. Now, at that time, it's impossible to tell if that rise will continue to create a new uptrend, or if it's what we call a bull trap, which traps the bulls into thinking the uptrend is going to return, and then from there the price drifts lower and it cuts through that support line and really starts to break down. The next very significant level is at 30,000. Because the Dow Jones was close to that period prior COVID, it became a very strong resistance level, and once it broke through, created a nice surge higher. So if the price of the Dow Jones was to break through 34,000, drift lower, and then break through this 30,000 mark, to me, that would indicate extreme danger ahead and most likely a major crash. Considering the macro landscape of the entire market, the Omicron variant is just another issue that the global economy is facing right now. We've also got massive stimulus flooding the market, which is leading to massive inflation rates across the globe. So I don't think Omicron itself is going to destroy the market, but it could just be that the accumulation effect of everything that's happened could catch up to the market, and the artificially high prices that have been generated due to all those factors we've mentioned before suddenly start to implode. So considering all the fundamental issues and the expense indicators we've looked at, for me, the risk is on the downside regarding the stock market and property markets in general. Let me know what you think in the comments below. I'd really love to hear your thoughts and how you've come about them. I'm Biko Konstantinos. If you enjoy my content at all, please consider subscribing, and I'll catch you next time.